Hi, this is Drew Tignanelli. This is our February update. Just give you an idea of, the markets have been bad this beginning of the year. They say when January is bad, that's a precursor to the whole year. Is that true?
Yeah, they also say it depends on who wins the Super Bowl.
Well, who did?
The NFC.
Oh, that's true.
That's
and that's a good thing, right?
Usually.
And then January's down, so put those together and we got a neutral market.
That's right.
Right.
That's right.
So, is the January thing really predictive?
Well, there's a lot of things that come into play with these predictive things, and they're not always as predictive as people say they are. You can always look back on data and make it tell a story. So is it really predictive of the future? That remains to be seen. Now, we had a great year in 2013. So the market, and we've been saying this for a couple of months now, was bound to have a little bit of a pullback. And so some of that
still hasn't had a big pullback, though, since 2009. It normally does about 20% every 5 years. We're now at the 5-year mark, and we still haven't had a 20% pullback.
Right, and depending on which market you look at, you look at the S&P down a little over 5%, the NASDAQ only about 4%, the Dow about 7% at this point, year to date. Bonds.
Transport's almost 10.
Yeah. So it really depends. International markets, a little bit harder in some spots, emerging and the like. So, but we're not seeing the 20%, real big pullback, or even 10 or 15 in the developed large cap markets yet.
But you're seeing a lot of individual stocks get hit pretty hard. Like today, actually, 3D printing, the new 3D printing, they were the darlings of the market. It was down 30% at one time today. It's rallied back in the middle of the day. I don't know where it's going to end up down, and today, when we're taping this, is Wednesday, February 5th, right?
Yep.
There you go. That was pretty good. That was pretty quick of me.
That was very good. That was good.
So what are we doing?
Well, your point is that these kinds of markets provide opportunities. So, earlier, before the market really did what it's done in the last couple of days, we had made some adjustments in all of the portfolios to really reposition them and prepare for a little bit of a pullback so that we'd be able to move in when the market rebounds. So clients will see that we had a little bit more activity in January than maybe they're used to seeing.
Right.
And so we've restructured, we've eliminated many of our balanced or moderate allocation kind of managers because as we looked at last year, and we were pretty conservative and they were even more conservative. So it caused us to be ultra conservative last year in some positions. So we want to have a little bit more targeting of our focus of our portfolio, be able to control a little bit more about how much we have in equities, how much we have in fixed income, in cash, and the like. So we've targeted by picking selective managers and be able to be in certain asset classes. International small cap, as an example, is a space that we think there's value in. And then when it comes to some of the individual securities we pick, this kind of market's going to give us that opportunity, and we're starting to see, wow.
We've already bought one,
Yep.
and we're going to probably pick up 2 or 3 more in the next few weeks. What I'm seeing is the opportunity seems to be arising.
Right. We've got this long list of companies we like, really solid companies, and with last year's moves, really weren't the prices we wanted to purchase them at. And we like to protect ourselves on the downside, protect our clients on the downside, and this market may give us an opportunity to buy some of those names. As you said, we already picked up one of them.
Right. So with the market down, you all of a sudden get calls, people, saying, hey, I've got college coming up next year, and what should I do? Should I be selling, and so forth? When the market's going down, that's not the time to be talking about that. So what would be our strategy with that?
Yeah, well, that's the challenge is, when we have a great year like last year, everybody wants to ride it all the way and take it as far as they can. It's going to keep going. And then all of a sudden we get a pullback like this and people get nervous. And we can
I need that money for college next year.
I need that. So, it really goes into all of the planning that we do with clients. And the way I think of it, we think of different buckets. You wouldn't take your emergency reserves, your cash reserves that we suggest you have, and put that into the markets. You're not going to be buying some emerging market stock with that, or even in the equity markets as a whole, because that's emergency reserves. And we may love the markets. Even back in March of '09, when we were down in the markets, we still would have never recommended that you take your emergency reserves and put it in the market, even though it was an incredible value, and we all saw that opportunity. So really, it's different buckets. And to your point, with college as an example, we had this call recently from a client. If your kids are approaching college, and mine, I just have 2 freshmen this year, in their college accounts, I went to cash a little over a year ago. Now, they didn't go up 32% last year, but they did have the peace of mind, and I had the peace of mind that that was going to be there when that tuition bill came. And so a lot of it is just really planning those different buckets. The retirement bucket's a different bucket, and I may like the markets, and I can be more aggressive in that bucket. And college accounts are unique in the sense that you have to take it out of that account if you have those accounts set up. If that's the only funds you have allocated for that. So it's really a matter of adjusting and taking in different places. So it is planning for the future. It's communicating that to us. So as we work that into your plan, as we're having regular meetings, we want to have that factored in. So it is good to communicate future cash flows and to think ahead and not get caught up in what the market's doing at any given point in time. And when we've had a great run, maybe it's saying, no, I should take a little off the table because I have this future expenditure coming down the line.
Well, this is very similar to when clients are dealing with stock options and the expiration of stock options. I always tell them, you cannot predict what a market is going to do in a year. I like to, use the example of 2008. Apple stock was trading at about 225, 250, somewhere in that range. And by the end of 2008, it was trading at 80. Nothing had happened in the company. But those people who had options with Apple expiring in 2008, waiting for that ultimate day, even though the company, nothing changed. The price changed dramatically because of the nature of how markets operate in a short period of time. My point is that you need it for college, you need it to buy a house, you're within 1 year of a stock option exercise. Whenever you need that money within a year, or something's going to expire within a year, you should be pulling the trigger and not looking back and saying, oh, I wished I would have waited another 6 months because it went up. You can't predict it. Just take it, run. Be happy with what you have. The peace of mind that you know you got it.
Exactly. I totally agree in that we need to be thinking ahead. And, even in your example, we may think that that's a great company and it's going to do well and it's got great long-term prospects. But sometimes an exogenous event occurs, like a 9/11, the market's closed for a period of days, the market goes down, there's volatility. We have no control over that. Apple, as an example, had no control over those kinds of things. So, we need to be thinking ahead and thinking of what our needs are and kind of creating these different buckets like that.
Great.